Hello everyone, and welcome to the Financial Prophet. In our last video, we discussed gold and silver stocks, and they have done great. The two stocks that I highlighted were Hecla Mining, symbol HL, and Pan American Silver, ticker PAAS. Now, Hecla was trading around $5 in mid to late May, and it surged to nearly $7 recently, representing about a 40% gain in just a few short weeks. I took some profits around $6.70, but the stock is still reasonably priced around $6 here. Now, Pan American Silver, the second silver stock I highlighted, was trading around $22 around then, and recently it hit about $30, also close to a 40% gain in just weeks. Now, today I want to discuss the Fed, the upcoming FOMC meeting, the week ahead, and the general state of the markets. Also, I will discuss my favorite gold mining stock and my favorite oil services play towards the end of this video. These two stocks could potentially double in the next year or so please make sure to stay with us until the very end. So let's get into this Federal Reserve report. So the Federal Reserve, or the Fed, has kept interest rates unchanged for about 6 months now. And now what started off as a path to an easier monetary policy last September has turned into a long and dragged out wait-and-see process. In fact, I've never seen anything like it in my 25 years of investing. The FOMC decreased rates by 100 basis points in the last few months of 2024, but it's been on hold ever since. So let's take a look at the Fed funds rate chart here. This is about a 25-year chart. This kind of easing policy, I have to say, is atypical when looking back, in the last 25 years, and we can even look back further. This is not something that the Fed has done many times before, where, it starts easing and then just kind of stops and holds rates relatively high. Meanwhile, treasuries, mortgages, and other key rates, they have surged and remain extremely elevated around multi-decade highs here. Let's take a look at the 30-year mortgage rate. So a 30-year mortgage in the US is now around 7%, about a 25-year high. Moreover, we've seen these ultra-high rates for years now, despite inflation dropping considerably in this time frame. What gives, you may ask? Well, the Fed is keeping rates high, and due to this ultra-high interest rate dynamic, there's increased risk in not only the mortgage market, but in the general credit system as well. Now, some of you may be thinking, wait a second, 7%, that may be high relative to recently, but historically, it's not that high. Well, while this may be true, the bottom line is that we've never had this much debt in the system, and it's much more challenging to service all this debt when interest rates are high. So basically, the economy, consumers, businesses, they have become very accustomed to low rates. Therefore, even a jump to a historical average rate of 7% for mortgages, now it's very high. And another thing is that house prices have increased considerably in recent years. Also, consumers continue to accumulate debt, but it's extremely challenging to refinance at attractive interest rates right now, as the funds rate remains elevated at about 4.33%. Of course, it's not just mortgages. Take a look at where credit card rates are these days. So here's the chart of the credit card rates, and we see that rates are around all-time highs here. It's actually eye-opening that credit card rates are this high. The average APR is over 20% now, which is remarkably high. Moreover, there's enormous credit card debt in the system, more than 1.3 trillion now. This represents a very sharp increase from only about 970 billion in early 2021. I mean, we're seeing more than a 30% jump in credit card debt in just around 4 years, which really is staggering. Therefore, it's not surprising that credit card delinquency rates have surged. So let's look at the delinquency rate chart here, and we see that the credit card delinquency rate in the US has spiked to over 3%, essentially doubling since the 2021 low of only about 1.5%. So again, this is a very sharp increase, and it is partially the product of of the Federal Reserve's high interest rate policy. Now, again, I just want to reiterate this, that credit card debt has grown by well over 30% since 2021, and the delinquency rates have surged, have essentially doubled since 2021. And also, it's not just the Fed, as the funds rate is high, but not anywhere near its all-time high. In fact, if we look back at the Fed funds rate, it was at about 6.5% around the 2000 peak, yet the average credit card rate was only about 16% then. So again, let's just put all of this into perspective. In 2000, we had about a 9.5% spread between the funds rate and the average APR rate. APR. Prior to the 2008 financial crisis, the APR peaked at about 13.5%, which illustrated about an 8.25% spread relative to the funds rate. In early 2019, the average APR peaked at around 15%, but the funds rate was only about 2.4% then. So this illustrates approximately a 12.5% spread. However, now there's about a 17% spread, which is just absolutely massive between the funds rate and the APR. So it appears that banks have grown greedier. However, it's likely more than that. The funds rate is very high, which influences essentially all rates in the United States. So the 10-year Treasury is about 4.4% here, which is also very high. And typically in an increased risk environment, it would be lower here. Nonetheless, many rates are stubbornly high despite inflation declining considerably since the 2021-2022 period. Therefore, we could be seeing such high spreads because of the general increased risk environment and the potential reduced demand for U.S.-related debt assets. Banks don't only want to make money, they also want to mitigate risk so that they don't lose too much money when the economy turns sour and they have to deal with credit card debt and other loan-related write-offs, which could hit the system like a pile of bricks. Honestly, we can probably talk about debt all day long. There is the massive $37 trillion national debt. Most of the United States government debt is in the form of 5, 10, and 30-year treasuries. Treasury rates are around multi-year highs, which makes the government debt much costlier to service. The annual servicing payment on the U.S. national debt is about $1 trillion now, roughly 20% of all government tax revenues. We can observe a similar dynamic with car loan debt, corporate debt, and just about any other kind of debt that you can think of. Rates are surging, delinquencies and defaults are rising. So where is the Fed when you need them most? So I have this really crucial question to ask. Is the Fed asleep at the wheel right now? There seems to be a significant debate whether the Fed is asleep at the wheel right now or not. On the one hand, some inflation readings remain above 2%, and we've seen a recent pop in oil and other commodity prices. On the other hand, rates are relatively high, the economy is slowing, and we could see more softness in the labor market and other key data as we advance. Also, the recent risk asset rally was likely supported by the expectations of a more accessible interest rate policy. When will the Fed cut rates? Well, there's only about a 0.4% probability that the Fed will cut rates on June 18th, this Wednesday. Likewise, the probabilities for a rate cut in July are also rather slim. There's only about a 23% probability that the Fed will cut at the July 30th FOMC meeting. Therefore, it appears that the Fed will probably cut rates in September and likely just one time after that in 2025. Also, I want to highlight that even for September, there's about a 30% likelihood that the Fed may still hold off on cutting rates. Still, the base case appears to be 2 cuts by year end. The million-dollar question is, will it be too late by then? As the economy is slowing and ultra-high rates will continue to weigh on consumer spending, confidence sentiment, and even may trigger a recession in H2 or early next year. It's not the base case scenario, it's not a likely scenario, but it is possible. Now, let's talk about the impact on stocks. The S&P 500 and stocks in general have made an excellent recovery since the early April bottom. In fact, we witnessed one of the speediest recoveries on record, with the S&P 500 surging by approximately 25% in only about 2 months. From a technical standpoint, the S&P is overbought. We saw the RSI hit around 70 in mid-May about a month ago. Since then, the market has pushed higher, but the RSI made a lower high, which implies that the bullish momentum may be worsening. We also see the full stochastic about to dip below 80, which suggests the momentum is worsening here. Also, we have not seen a meaningful pullback since the new uptrend began. There's an unfilled gap around 5,700 in the S&P, and a 5% pullback would bring the S&P and to this crucial support area. Of course, it's not guaranteed that the market will correct that much in the near term. However, technically, it makes sense. And from a fundamental standpoint, things are not exactly 100% rosy here in some regards. We still have considerable trade-related uncertainties, and Liberation Day 2.0 should arrive around July 9th. Will we see many trade deals before then? What will happen on July 9th? How will the market react? Let's keep in mind that the quote deadline is about 3 weeks away, and the only trade deal that has been finalized is the deal with the United Kingdom, probably the easiest deal to actually make. There are many, many uncertainties, and not just with Liberation Day, with the next Liberation Day. We could see worsening labor, inflation, and other data that could contribute to increased volatility in the near term. We could also see a considerable earnings slowdown, and seasonally, the market may be due for a pullback. There are numerous geopolitical and other risks that may also contribute to the increased turbulence. Therefore, I believe the probabilities for a near-term pullback of about 5% are increasing, and we could see the S&P 500 correct to about the 5,700 level in a base case outcome, in my view. Having said that, this potential pullback would very likely create considerable buying opportunities, and I remain bullish in the intermediate and long term. Despite the likelihood for more near-term volatility, I'm keeping my year-end S&P 500 target at 6,500. So I promised you 2 stocks. Well, my favorite gold miner is Newmont Mining, NEM, and it's the most significant gold miner globally, and it seems very, very underrated here. It's trading at only about 12 times forward earnings, and these estimates may be very, very low right now, especially considering where gold prices are today and where they could be tomorrow. NEM could be one of the biggest beneficiary of higher gold prices, and the market seems very much behind the curve on this stock and many other gold miners, really. And the second stock is my favorite oil services stock, which is SLB Schlumberger. It is extremely undervalued here, I believe, because it has only about a 10 forward PE multiple, and this company is the top oil services company globally. Therefore, I think it's really being undervalued here, and with oil prices likely to move above 70 and stay above 70, maybe even move towards 80 or higher, we could see Schlumberger's price increase considerably in future months as well as in future years. I thank you very much for watching my video. I hope that you enjoyed this profit report. And more importantly, I hope that it helps you make more informed decisions going forward. I would also like to hear your comments, so please join the conversation in the comment section below. If you like this video, please click like, share, and subscribe to my channel so I can continue making these great videos for you guys. You can also join the Financial Profit, my exclusive investment community, which is seeking Alpha's #1 service for proven portfolio profits. Thank you very much for watching. See you next time, and have a wonderful day.